Okay, I think I might get emotional about this one. Um, I'm going to talk to you about the modeling and what you want out of modeling in the IRR. Okay, and I would like to talk to you about a couple of recent emails I received from these idiots. This man, this professor who said, and these people who were so proud of it, they put, we're so proud. The professor said IRR is bullshit. Okay, I'm going to talk about the history of the IRR. Maybe it's, of course, any statistic has problems, and it has a lot of problems. Everybody knows. If this stupid, this professor said, oh, the IRR makes a reinvestment assumption about that you're getting the same rate as the IRR, everybody knows that. I'm old enough to know what happened before IRRs. You used to have to compute IRRs on a slide rule. People want a performance measure for investors. Investors need a performance measure of how their project is doing. So when these blowhards talk about the IRR is bad, um, what's their alternative? So this is this place called AIF, who doesn't have any more modeling classes. They're too right. And there's this lady from AIF who says, quotes, the IRR is bullshit. What a jerk. What a whole thing. And then I received from a really nice guy, I received a couple of articles. There are 3 articles, good ones. It says that, oh, the current tools are bad. This is exactly replicating the new economy, that everything's an option and all that. Fine, whatever. Another one, recently, IRR is bad. And then there's this famous thing from McKinsey that says you should use MIRR instead of IRR. What a crock of crap that is. Unbelievable. Okay, now I had some good questions from people in my class, not these ridiculous ones from Amsterdam Institute of Finance. Yeah, the good questions are one lady said, well, if you look at a model and you put your refinancing in a model and you put some sales of the project in, you can kind of get whatever IRR you want. And isn't just this just a number in the financial model that we just have to present? She's got that's kind of a good point. And then another wonderful lawyer years and years ago told me, what is this business of IRR anyway? What's this business of IRR? And I said, oh, everybody knows. What does it mean? I said, well, the IRR is just the discount rate that makes the NPV equal to zero. Everybody knows that. And she said, what, you idiot? You mean that every chief executive officer and every project finance evaluator and everything else is trying to find the discount rate that makes the NPV equal to zero, and that's a real measure of performance? She was, of course, right. The IRR is just a growth rate in your money. Now, when I suggest, here's when I have a class now, before I have a go into the modeling and all that, I say, what kind of measures of performance do you actually want in a model? And I start with a whole series of IRRs. So this man, this Oxford Mr. Professor, said, oh, these IRRs are bullshit. Well, that's what everybody seems to present. Do these finance professors think that that all the people who were making analysis with real money are wrong? And then I said, well, for the lenders and for the credit analysis, you need a series of DSCRs, and did I spell it wrong? DSCR? Oh my God. Oh well. And so I'm going to take you through a couple models as we go along. So here's an example of a model. I'll give you a version of this. I had to put a horrible copy and paste macro up there. So I might present, and it's a good suggestion. Hetty said, present the sources and uses of funds, then some general credit statistics, and then kind of how you're financing. And that's the summary. That's what you want out of a model. Okay, enough of that. I'm going to close this Elvis Solar model. Okay, and then let's continue. Continue with some good theory. All right. And now, the question is, final question is, if you're not going to compute the IRR, if the IRR is bullshit, how are you going to measure the performance of a project? Are you going to be qualitative? But if you could use NPV, of course. Doesn't really provide any different information than the IRR. You could try this MIRR, which totally doesn't work for anything. You could do something I suggest, which is the weighted average ROIC that nobody will ever use, but it is a little bit corrects a couple of little problems in the IRR, perhaps not. The problem is all of these are require some kind of WACC, weighted average cost of capital. If you want to say one thing's bullshit in finance, say it's WACC, not IRR. I think the reason people couldn't, IRR has gotten so popular is the old days you'd have to compute it with a slide rule. Nowadays you can put a little formula in Excel to do it. And these people can't seem to make a little financial model to prove anything. Just so pissed off about this. Now, there is something, and I've done this again and again. Tough crap. If you can turn off the video, if you want to look at how much money, how many things you can buy, I've put a graph of two things here. I've put the DAX and the US S&P 500. Two graphs. And if you started in here 1990, you started in 1990, so that's what 28 years ago or whatever it is. That's okay. You could 29. You could in the S&P 500. Now Yahoo is wonderful with all the stocks. They provide something called an adjusted stock price. They're better than these stupid professors. They really are. With an adjusted stock price, the big advantage is you reinvest. You reinvest the dividends, and when you reinvest the dividends, you can see how much money you got left over when you're finished. If you buy the stock, reinvestment the dividends, and sell the stock. What a wonderful thing to publish. And they publish this going all the way back. And of course, I have these stock price databases that nobody seems to give a crap about. But the one thing I compute with them is the IRR. And if you invest in the S&P 500 on a nominal basis, you would have got about 8%. If you would invest in the DAX, you would have got 7.68. The interesting thing is when you move over here, it's just the growth rate. You could take this series and take this number divided by this number raised to the 1 divided by 29.66 years minus 1, and then you would get the growth rate, the compound growth rate, and that's the IRR, how much your money grows. And if you did this, your money would have grown by 8.8, or with the IRR of 7.92, 7.68, 6.78, a little less than 1%, you would have only got 6.56. If you're trying to buy Lamborghinis and you put enough for one Lamborghini here and you want to buy your grandchildren more Lamborghinis, you could have bought 8 of them if you invested and got a little bit higher IRR than if you got 6%, 6.78% IRR. This says a lot. And what you do to do this, I'm going to take you through some, well, I'll do that later. I'm changing my mind. I'm going to just go through this. Now, if you, okay. The real problem with WACC is that it's got you've got these ridiculous assumptions about the equity market risk premium. Now, the general idea of a risk premium is that the general idea of this equity risk premium, okay, it sounds good. You need a premium if you're not going to invest in risk-free securities. Good, maybe. But you can say, let's say you invest in every single stock and other asset in the economy. Then your asset should go, your value should go up in the long term with economic growth. You don't have that much risk. If you invest in a gigantic portfolio, you have overall economic risk. And if you invest in a bond, you have inflation risk. You can't tell me necessarily that if you invest in some enormous portfolio, that risk is more than the risk of inflation changing, because the assets go up with the real economy. And you could go further and say, okay, well, if you need a risk premium, if investors need a risk premium, then investors need the profits on their stocks to go up by faster than the overall economic growth. And if they're going to profit from that, then they're going to get really rich, and the people who don't make an investment are going to get really poor. And you can explain all of the distribution in income in the world, or especially in places that have had a bigger change in the distribution in income, exactly by this. You could, of course, say, well, employees, they take risk. Why shouldn't they get a risk premium too? And then, no, the risk premium just doesn't come from anywhere. It's got to come from somewhere. Idiots. So here I made another graph, and I'm going to take you through this at the end of the video. Here I made another graph, and S&P compared to the Dow Jones. This is this wonderful Yahoo. They are good. I don't pay them anything. Why should I steal them? The data, I don't steal it. I just download it. Okay, this difference from, when was this? 1986, is that right? Yeah, that's when the Dow kind of started. They started publishing the Dow in 1985. This little difference between 8.37 and 9.02 gives you 16 Lamborghinis instead of 13 Lamborghinis if you invested enough for one right here, and if you're doing this on a nominal basis. Now, the next thing you can do, there's another thing called FRED, the Federal Reserve, blah, blah, blah. I've talked about this a lot. They publish all this stuff, and you can combine with a lookup function. You can easily combine. Why don't they do these professors? You can combine the economic growth with this S&P 500, and here, this one, I went all the way back to 1950. And back here, blah, 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 stocks, the S&P 500, growing about the same rate as the economy. People were living good lives, what the heck. Then came the 1990s, the stock boom, and then the dot-com crash, the Lehman Brothers, the tax reductions, and then more volatility. But here, suddenly we got a big difference in stocks versus the economy, and everybody's going crazy about populism and everything else in the world, because some people who don't have as many stocks feel a whole lot left out, because if your economy was growing, let's do this with houses. If you started in 1974, you're supposed to be, what a bunch of crap this economy stuff is too, in nominal terms. So this is nominal terms. You're better off. One houses were 74 today. Whatever. The economy's grown by this much, and the stocks have grown by a lot more. But then, if you do this starting in about 1984, that's when things really started to change, and this dispersion kind of is more extreme. And I think that's, so to say that, we need these gigantic risk premiums is kind of silly. And then this one, because of Fred and Yar, you can do the same thing, but this time I'm going to show you this at the end of the video. People have probably turned it off by now already, but you can do this without inflation. So you just put a little thingamajig here, and you put what kind of inflation you want. Whatever divides this by the inflation index, divides the economy growth by this, and now we got a much more sensible thing once we take out inflation. So with stocks, you would have been able to, in real terms, get 7.4 Lamborghinis, only 2 more, with your whatever, with just by growing and being an average person in the economy. And here it is over a long-term period. It's got the same thing. It just kind of shows it nicer. And then, so now let's talk about this, my friend. Aswath whose website's more popular than mine, and here's the risk premium. He says the risk premium is 6%. And he says somebody named Fernandez says that they looked and they say this risk premium. Do you know how much 5% is, or 5.6 is over a long-term period? And then he has this big discussion, and he finally says, I don't know if I should use 5.6.12 or 4.5 or so. Oh God, oh my God, and then it's really laughable. And then he comes up with 5.96. That's our risk premium that investors need over bonds. And let's show you what that means. I have got to get the data here. So we're going to go to this data. And first of all, I'm going to take away the DAX. And I'm going to instead, Fred allows you to publish, and who knows what kind of bonds people should compare it to. I think I used to read that it should be long-term bonds. Bullshit. Whatever. They got inflation risk. Okay. Here's it's nice and smooth. Yeah. That's the interest rate. If you went back, let's go all the way back to the 50s. If we went back to the 50s, even before I was born, this you would have made, with all inflation and everything else, 5.71 if you kept on reinvesting in the bonds versus 7.54. That's not an enormous risk premium. It is a risk premium. If you, by the way, stopped earlier, that risk premium, here, maybe I stopped at a funny place. Whatever, that risk premium is 8.22, 2%. Let's stop even earlier. Okay, and then we have very little risk premium. Very, very little evidence of a risk premium. And you can do this in real terms I'll just deflate it by the GDP and deflate or recalculate it. And you can kind of see what the risk premium is. Okay? That's kind of funny looking, isn't it? Let's go all the way back to today, because I'm kind of more familiar with that graph. And that's the risk premium. And what in real terms, 4.21 versus 2.6, a 2% risk premium you would have earned. That's a lot. It's caused all sorts of problems in the world, enormous problems in the world, that you've earned so much. If you start at a different point in time, here you get about 3%. That's pretty much. Okay, let's work with the raw data and see what we would have gotten if we would have taken this line and added a 5.5% risk premium to this line. It's going to be a big number, because right now the treasuries they already earn 5.71%, and maybe let's not do it that extreme. Let's go to how about let's go to 1970. Let's try it there. And in this case, we also had a very, very low risk premium. So let's go to it. I don't want to make it absurdly extreme. Yeah, now we have a little bit of a risk premium. 8.7% versus 6.28%. Let's see. No, I'm sorry. One more. I want to get it to the point where that was 1980. Now our bond yields are going down. Now they're to 4. How about we'll just do it for 20 years? Maybe we want to get some higher values of stocks. Let's start here. All right, that sounds good. 1993 to 2018. The task is to see what would have happened if we take this bond line and add our risk premium to it. So the first thing you can do is you can go to the summary page, and in the summary page it has all of the data that gets downloaded directly from our friends at finance.yahoo.com. So here's the stock index that, excuse me, went from whatever it was, come on, up to here, thousands, whatever. This is and there are some declines, and this is month by month data. And then you go over here and you get the index of it. Okay, so, and then when you copy this index, it goes down to 1 after the last date. So I'm going to throw that into another file and paste Alt ESV, paste it special. Okay, and this is the stock index. Now let's go back to that file, and now let's find the bond index, and that's over here. We've got the bonds, and you can look at it all and get this stuff yourself. Okay, and let's put the bonds in there. Okay, and if we want to double check, let's check to make sure we're okay. So let's go down, and when we hit our ones, let's stop it. Okay, and you can see we've got some risk premium on the stocks relative to the bonds. And if you go up here, you can press 1. I think you can double click on this, Alt-ES, Alt-EIS, and it just will give you that there are 321 periods. And just to review again what the IRR really is, we put the last value divided by the first value, which is 1, and we raise it to the period of 320. We raise it to 320, and we don't raise it to 320, you raise it to 1 divided by 320, and you put a -1, and that gives you the monthly return. Okay, Shift Control P, and then you can get the annual, and that's the IRR. Okay, and if you don't believe that it's the IRR, I guess I'm going to waste my time proving it to you. And that's why the IRR is what's underneath economics or capitalism. And I'm not sure that's exactly the IRR we had, but I think it is. If you wanted to prove it, you'd put a -1 here, and then you put a 0, and just double click on that 0. And you go down to the end and put an equal sign, go to this one, go up back, and put equal IRR. And if I didn't tell you it was okay, I had to put a little 0.001 in there, and it gives you exactly the same IRR, and you can compute it. Okay, so now what we're going to do is see Dr. Damaradan says, he tells me that he comes up with this black box magic potion. Oh, that's 5.96. So from 1993, let's see, if we would have had a 5.96 return, let's put a 5.96% premium here. Oops, I'm having trouble typing today. 96. Oh, geez. 96. And then we can press that 1 plus that one raised to the 1 divided by 12 minus 1. That gives our monthly. So 5.9 6% premium, and we start with our 1, and we take that premium, multiply it by 1 plus the monthly premium. Sorry about going through this slowly, but whatever. And that one, the premium would have given you not quite as much as the IRR, of course, but we're going to add this premium to the bond premium, and we can't just add them. We have to then we put bonds plus the premium, and we can just take this one, multiply by this one, and see how much we would get. I'm pressing F9 because that other thing was open. And then we get 14 compared to 6 over the period 1993. Whoops. So let's, if I did it another way, it would be too extreme. This is a period where the returns on the stocks really were pretty good. If you look at those stock markets, and then, so why don't we just graph this? Let's just see that. And I'm going to press the F11 key if I can find it on my little computer, and I don't want to add a chart element. I want to change the chart type maybe, and let's put it as a line chart. Do the boring stuff, and this is the kind of, this is what you would have gotten. I can't get rid of those stupid, there must be, what'd you do to get rid of them? Whatever. This is what you would have got if you would have put these two premiums together and done a little compounding, and you recognize that IRR is all about exponential issues, and even with the massive increase in the stock market, it would have been this. And I argue there would be another really, really bad French Revolution here, because people who invest in the stocks would be so rich, and people who didn't. If I didn't convince you that this equity risk premium is bullshit by now, well, that's too bad. I guess I can't. But that it really is. These kind of things, when you just look at it logically, why can't these wonderful financial people, the business school professors, why can't they get into the real world? Oh, enough of this. Now, when we look, if we want to say IRR tool is bullshit and replace this AIF, man, IRR is bullshit, and we're going to replace it by something else, we have to use the WACC. Now I've got my classic kind of WACC things. This is a transaction. The WACC in the buy side or the sell side, whatever it was, one investment bank, real smart people, said 8.6, another said 5.9. And if you change the WACC just a little, look at if you change the WACC and the growth rates, 1%, 55 to 30, 64 to 30. What a gee. That WACC is so, no wonder people don't like all these methods that depend on this WACC with the 5.56% risk premium. What a lot of crap. And then you can go to this WACC expert, and they tell me that the WACC for an insurance company 6.69 to 12. My friend, he gave me this, and he said, "Oh, look at this." And I go, "Oh my God." And then this is another kind of classic things, you can hardly see this, but a very, very small change in the discount rate leads to enormous things, no matter how much you try to color these things in the middle. What a bunch of crap that is, too. Just enormous. So and look at this one, 4.89 to 1.42. This was some fancy little Air Arabia thing. The actual price is lower than this one, I think. Oh well. Okay. And then, so here are our alternatives. I'm just going to go through this. We could try this MIR. That says, nah, we don't invest in the WACC. We're going to reinvest at the WACC. Okay, because maybe we're having this great project that has an enormous, wonderful, return. So when we get money in the middle, that's the problem, is getting money in the middle with the IRR. I'm going to go through the mathematics. NPV we could measure. We could compute the NPV and measure that at the WACC. We could even take the NPV divided by the investment. And then you get basically the same result as the IRR, by the way. And then you can do this weighted average ROIC that I've talked about elsewhere, or economic depreciation. And maybe professors, they say, let's use the NPV rule. But, managers are busy. If you got a $10,000 project versus a $340,000 project, how do you know which is better? You could divide it by the investments. But then, you have to sit here and debate about the WACC all the time. The IRR just gives you a nice number, and it's a real number. It's the number that gave you how many cars you can buy. It's a real number, Mr. Professors, okay, because you're looking for similar investments that you made. Okay, you can divide this, of course, and it's a highly dependent. So you can make a little table, and here's what I did here. Let me find our... I think I'm going to close this file for a minute. How to format this file. So the way this file works is I made some just simple assumptions about some capex, how long the life is, what the growth rate is, WACC, I called what a crop of crap, IRRs, MIRs as an output. I should put the NPV here, I guess, and the NPV, and I didn't do a payback, okay, and I should do the weighted average return on investment as some alternatives to the WACC. Now, everybody, I hope, agrees that a return on investment is okay. Now, if you get a file like this, if you press now Control-Alt-C with the generic macros open, this is kind of cool. It goes and finds the exact column now, so you don't have to waste your time. I spent a lot of time, and it tries to find a sum column. If it doesn't find one, it puts there. And then let's put a little dashboard. You still might have to do that one. And let's put the dashboard all the way to 11. So let's not waste any time other than the time I just wasted with you in coloring. Our colors, and that's what I wanted it to do. Okay, excuse me. All right, and I put some sensitivities in. So in this case, our EBITDA was growing. I have a 40-year life. Let me change it to a 30-year life, perhaps. And then we have our IRRs and our MIRRs, which I measure at the WACC. So MIRR, you just put in I put in the same rate for the investment period and the repayment period. Okay, and then I go down and say, okay, let's compute our return on invested capital, which is really a measure of performance, which is what you're trying to do in a model, Mr. Professor Man. And the ROIC you can't get because of depreciation, it goes crazy. It goes really high. And even if you have a depreciation life that's different from the average life, what you can do is put a little epsilon around your I put 99% with the regular life and a little bit extra. I'm racing through this, and you can get an ROIC then, but then you can weight the ROIC, which I've talked about elsewhere, so I'm not going to redo that, and you can weight the ROIC with WACC, where you put a weighted average, where you adjust the investment you have, the net plant minus accumulated depreciation plus working capital, deferred taxes, whatever you want to put in there. And you can take this invested capital, take the present value of that in each period, weight that, and you get a weighted average ROIC. And then you can also put exactly what the IRR does. It assumes there's reinvestment. Now, if you really want to get into this, the reinvestment is a lot. Here's how much basic cash flow you make in this scenario. Here's how you make, this is just the sum column. Here's how, Control-Alt-C, I've got to do that sum column to be F. And it found it as F now. And I'm going to put a border around it. And hopefully there's our sum column. okay? And you don't have to sit there and waste time formatting, even though I might have wasted your time now. And then you can accumulate how much cash you get. This is just like a debt balance. And I stopped at the end of the life. Okay, so this is the opening balance. You add the pure cash flow you get, then you take your opening balance, and you don't put any minus in. You just start with zero. And this, when you take the total amount you received, I mean, this is to me almost too obvious. But if you put a minus on the investment you made, and we said we're making an investment here of 1,000. And why didn't I freeze the panes? That was idiotic. Okay. When you freeze the panes, let's put the minus 1,000. Let's put 0. Now, if you don't use this Shift Control R, it always takes you to the end, and then you always got to go back. And then if you put a positive for the last one, okay, then that's the growth rate in your investment. And if you see, let's see if that's really going to be equal to the IRR. Let's put an equal IRR on that. And you get exactly the same IRR. And if you want to take the growth rate, they're going to be, I think they're going to be 29 periods. Let's take that last one that we have, the last value, divided by the 1,000 we have, and let's put a minus on it. And then let's raise that quantity to the 1 divided by 30 minus, whoops, shoot, can't do Excel anymore. The total, so the growth and the IRR is just the growth rate. And Mr. Professors who say the IRR is bullshit, can you just understand that when we looked at the economy, in a capitalist economy, whether you like it or not, everything seems to be about growth. That's what people complain about for global warming and everything else. People only care about growth, and IRR is growth. It's growth with the IRR being the same. Now, if you use the WACC instead and would compute the amount of money you make, and then this is how much money we make in between if we use a different WACC. Let's put a higher EBITDA and get a higher IRR. And now our IRR is 12, gigantic, and our WACC is 7%, still very gigantic. You can see then when you get to this table and you kind of put your reinvestment here at 7.5, instead of finding another investment like your one you're looking at, you get a lot more. This one you get 35 times your money. This one, if you make a lower reinvestment, you only get 14 times your money. Okay? Everybody knows that. You think you're going to go teach a class and say, oh, I know that. Good for you. Oh, shit. Now you can compute this economic depreciation, and then you can compute an ROI that's exactly equal to the WACC. I've done that in a different video. That's exactly the same. And if somebody says the ROI is an irrelevant measure, go to heck. What else are you going to measure? You measure the amount of investment you put and the amount you get back. ROI is the measurement of just about everything. You say you're going to measure performance. What else are you going to use? And then you can you can do that with a different discount rate, but it only really works with the IRR. Now let's just look at some of this stuff. Okay, so I made a data table, and in the data table I just put in up here the MIRR, and I put it right here, I think too. Here's our, oh no, let's do the investment one first. Let's do the NPV one first. Okay, excuse me for going back and forth. We'll revisit this in one moment. So you can take the NPV and say, I'm better, I take the NPV. let's divide the NPV by the investment. That's easy to do. I think I did that right up here where we, and I'll put this file up if you care. It's very simple. I take the amount, our 1,000 of investment, and take the NPV at the weighted average cost of capital, and then I add the investment, add the NPV to the investment, and that gives you something like a price to book ratio, and that's okay. Nothing wrong with that. Nothing wrong at all with that. And you can see what's the NPV related to the investment you make, and if it's above 1, you're earning more than your cost of capital. Everybody knows that, I hope. And then, but then you can just look down, and when it's a 1, you earn your cost of capital. You know what that happens to be? That happens to be the IRR that you're saying is bullshit. Okay, you're not going to get away from the IRR in the real world. Okay, and then you can do this same thing. And where did I put it with the oh, well, no. Okay, yeah, I'm going to do it later. But first, let's talk about Mr. Bezos and his wife. And he paid her 38 million. He should have told the whatever negotiated with her and said, you know, my whack was really high. That money isn't real that I earn. My 38 billion or whatever, hundreds of billions, that's not real because my whack was higher. It's not, the IRR measures the amount of money you actually have. Let's see what kind of IRR he earned in order to get to pay his ex-wife 38 billion. Okay? And here's what you do. And we go back to the multiple stock price graph, and then we can look at a couple of different stocks. So if you look at Sprint, okay, and then you can, that didn't do so well. You would have got a lot more on bonds. The IRR on Sprint was not negative if you started way back in before it even started trading. Okay, you have to start in 1988. And oh God, I can't see this. And my eyes are going. I hope my eyes don't go. Okay, that's the stock price. But now, and there's the index, treasury bonds, blah, blah, blah. Let's take that off. Let's talk about Mr. Bezos, and why he takes all the money that he took from people and he invested in rocket ships. And here's his IRR. His IRR, not that dramatic. If you start from, let's start from when his stock started, which was 1997, just before kind of all the dot-com bubble. He had some good years here and then some really bad years. I remember people talking about Amazon right here. And his IRR is 38%. People talk about 38%. What's the big deal? 38%, 6%. What's the big deal? 3%. Well, here's the big deal. You took 1, and the 1 becomes 184.19. That's his IRR. That's how much money he made on an investment of 1. That's what the IRR means, you Oxford professors. That's what it means. It's very real. Tell me it's not real. Okay, so now let's go back, and I think I'm going to, you know, when you can summarize these things, what I do is then put these little things. I'm going to just, while I'm making the video, put this in our little PowerPoint slides so I can tell other people in my classes what it really means, which is really why I make the videos anyway. I'll put it here for now. Okay, and then now if you would measure his MIR, Mr. Bezos' MIR instead, you would have said, he didn't get a very high return because he has to reinvest all that money. Where is this one? I put the wrong thing here. Whatever. And then let's if you but if you assume that you invested a high you put a high whack into the MIR, you get a higher return. So when you're looking at your performance of a company, all you're measuring with this MIR, which is this thing McKinsey seems to like so much, you're just measuring the whack itself. And you put a higher whack, you get a higher return because that's where all the money is. It's in the reinvestment. I know that's a problem with whack. And these ones show the difference between the weighted average return on investment. This blue one's the whack, and the other one's with the weighted average one. And then we have another. I did another scenario with where I have a little bit of a higher whack, and in this case, you can see that the return on if the whack is if you want a whack, I hate saying it, but if you want it and you don't like the IRR, if you're earning a higher return than your IRR, then this is higher. The MIR would say it's lower because the MIR, just you have a lower whack, you got a lower return. Oh my God, how could people use it? When you really look at it, Jesus, they try to sound so much. Now there's real critiques of the IR. I know that if the risk is changing over time, which it always does, the whack is not constant. You can't compute NPVs. What you need to do is have a holding period and make an assumed sale, like you do in an LBO model. The other thing is the whack does, because of the reinvestment, if you have these really high whacks in Africa, it tends to understate the out year cash flows. That happens. I've got other videos about that. And now I'm going to stop the video and I'm going to make another video on a case study of it. Okay, and I'll have a little comment where these things go.